So our next panel is going to be the funding landscape. 2017 looks bullish for early stage investing in IPOs. But before that panel, let's have a word from our sponsor, Michael Ruddle, the managing attorney of Ruddle Law, a professional corporation in Torrance, California that provides immigration solutions to business owners, their employees, and their families. Michael, yes, you can.
Thank you, everybody. I won't be long. Good evening, everybody. It's an honor to be here tonight. The entrepreneurial spirit, it's very uplifting and contagious. When you leave here, you're going to have that let's do it attitude. Did you know that last year at this time in the U.S., there were 87 startups valued at $1 billion or more? More than 50% had at least one immigrant founder. More than 70% of those had at least one immigrant in a key management position. In fact, our last great speaker brought up the company Instagram. One of those co-founders, Mike, is from Brazil and was quoted in Bloomberg Business as saying that he had an easier time getting Instagram going than getting his visa. Now, as an immigration lawyer, my job is to just help my clients with what can seem like an overwhelming process and turning that into a smooth operation. You guys, you want to be focusing on business development, client development, raising capital. You don't want to be dealing with government bureaucracy. So that's what my firm does. We specialize in helping business owners, their employees, and their families. My name is Michael Ruddle. I'm an immigration lawyer. We're located in Torrance. Thank you for your time, and I hope you guys have a pleasant evening.
Thank you. So let me introduce the host of this panel, Carmen Palafox, who's partner of Make in LA, an accelerator early stage venture firm specializing in technology-enabled hardware. Some of the categories they work in are Internet of Things, robotics, wearables, augmented reality, virtual reality. Let's have a round of applause for Carmen.
Thank you. Thank you, and good evening, everybody. So I'm going to call up our panelists, our venture capital panelists. I see Richard June over there, just finishing off his beer. He is the managing partner of BAM Ventures. Please give him a round of applause. And then I also see Laurent over there. Come on up. He is the program director for Luma launch. Is Ryan Garrett here? There he is. The co-founder and managing director of Crosscut. And Colleen. Colleen, just single name. Vice President of Core Innovation Capital. So we have about 5 prepared questions, and then we want to get to Q&A as soon as possible to help you guys out in your entrepreneurship path. All right, so first off, though, we hopefully have one more mic going over there. I just gave you everyone's name, but what you really should know is what these VCs focus on, what their primary sector is, and then what stage they invest in. So why don't you start us off?
Sure. My name's... Hello? Hello? Hello, everyone. Thanks for having me. My name is Richard Zhang. I'm with BAM Ventures. We are an early stage seed fund here in Los Angeles. My partner is Brian Lee. You may have heard of him. He started LegalZoom, ShoeDazzle, which we sold to Adam and JustFab, and now Honest Company. In addition to investing in seed, pre-seed, we also incubate companies. The last company we incubated is a company called Holler.com, which was just invested in by Klein Perkins.
Nice.
My name is Laurent. I'm the program director at Luma Launch. We are also a pre-seed and seed venture fund with an accelerator program attached. We're looking at easily scalable software companies. What that means is we're looking at industry agnostic companies that don't require a lot of capital to grow. Aside from that, the stage is variable, pre-seed being as early as incubation, and we'll look as late as Series A. Still not working. Anything else?
to continue to stimulate creativity in the SoCal tech ecosystem. And people ask what we invest in. We say anything that SoCal's gotten good at. And luckily for us, when we started the fund back in '08, that was ad tech and e-com. And now it's 12 to 15 different categories of areas of innovation that LA is producing interesting businesses around. So 4 partners at the fund. Last fund, or I guess first fund was 5 million, second fund was 16 million, third fund was 75 million, and we did 12 deals last year, writing $1 million checks alongside co-investors, typical rounds, $2.5–3 million.
Hey everyone, I'm Colleen Poynton. I'm the Vice President with Core Innovation Capital. We're an early stage fund focused entirely on financial services and financial technology. We invest predominantly in companies in the Series A, so our sweet spot is like a $1 to $4 million check into something like a $6 or $8 million round. We lead, I would say, about 60 to 70% of the time, putting down term sheets. We also do a little bit of earlier stage seed investing, more in the neighborhood of 200K checks, typically not leading in those scenarios. We are on our second fund now. So the first fund was a $45 million fund. We just announced the close of our second $75 million fund. In sum, we're investing in companies that use technology to drive efficiencies across the board in financial services and create real quantifiable value for consumers and small businesses.
We've just been joined by Kevin of Upfront Ventures. No worries.
Likes the dramatic intro.
Yeah.
I'm very sorry. I work at Upfront Ventures. We're in Santa Monica. I've been in LA for the last 20 years. Pretty much the same strategy always, very straightforward. Series A lead investors. So 6 of us write checks. We only do 1 to 2 deals a year, pretty concentrated portfolio. We invest across software, hardware, even within the life sciences. I personally spend time on gaming, virtual reality, and healthcare.
All right, so now that you know who we are, can you please help us with a little bit about who you are? And if you are currently raising money, can you raise your hand? All right. How about for those who have raised money, can you raise your hand? And who's an entrepreneur out there? Okay. All right, well, we'll get started with our prepared questions. The first one is, what's the state of venture capital in pre-seed, seed to Series A, and the funding landscape in LA? Why don't you kick us off?
When you asked, there was a question of whether or not we've had a lull in 2016, and that was something that we were looking at, and frankly, I think that venture capital has taken a lot of turns, but more recently it's actually done quite well. I think we're all kind of laughing about the thought process that venture capital and entrepreneurship and seed stage companies are on the down, but in reality there's tons of companies, there's tons of funding. And a lot of companies are raising big funds in LA. A lot of VCs are raising big funds in LA. A lot of companies are raising money. Going into 2016, I think you're seeing some interesting industries that are starting to take the lead. As Kevin mentioned, VR, AR have, in the last couple of years, have come to the forefront of some of the more innovative tech. But there's also healthcare tech, biotech, cell regeneration and longevity is an interesting play. We're starting to actually see some pretty impressive companies that are sort of leading that industry, which is very complicated, but you're going to see, I think, in the next couple of years, some people taking strides towards living longer. And so I think 2016, 2017, you'll see that transition into a variety of mediums that are completely game-changing. And I think that, again, to his point, they're upfront on looking at a lot of that stuff as well. So
I think you can always say that it's much more competitive, and we use that as an advantage to maybe drive down valuations with entrepreneurs. But it's less about there being less money out there. There are enough funds with enough capital to put into seed pre-seed, certainly that's something that I'll speak to, they can speak about later stage companies, but what you're bumping up against isn't necessarily the shortage of capital, but more a glut of opportunity. What we've noticed is a continuation of what we've seen in 2015, 16, and more so in 2017. There's just a lot of great companies out there and a lot of great entrepreneurs, and everyone's looking for your money. So it's less about, are people willing to fund my deal versus are people willing to fund my deal because they have opportunity cost in maybe missing out on the next deal. So it's less about the economy, more about it just being incredibly competitive with a glut of great companies that are out there.
Brian, what are your thoughts on LA and the funding landscape at different stages?
Yeah, so we do a little pre-seed stuff, mostly seed rounds. Very active year for us in 16. What we were most nervous about is that next round of capital, and I think what happened in 16 will continue to happen in 17 is that the A-round investors are getting more risk averse and waiting for greater milestones to be achieved. So there's a glut of capital available from all these micro venture funds that are popping up, and it's not hard to start a micro venture fund today. There's a lot of money in the system. You get a little bit of angel track record, you can go raise $5-10 million and you're in business. So what I'm most nervous about is those companies trying to raise the follow-on capital from funds like Upfront and Silicon Valley, and the bar is 10 feet higher than it was a year and a half ago. And so I think we're going to have some carnage across the board. But this is my third cycle, and I've been doing this a very long time. It's actually a healthy cleansing in some ways. Like, you got to get rid of the businesses that really didn't deserve to be there in the first place, or there shouldn't be 5 competitors going after one new disruptive category. There's too much capital chasing a single, what usually ends up being one market winner. So I think we're going to see that in 17. I think it's going to be hard to raise capital in the A round. There's plenty of capital chasing pre-seeds.
And can they do that? Can startups do that all in LA now? How far can startups go in terms of funding in Los Angeles?
So, Upfront may not agree with this statement, but I think there's plenty of capital for pre-seed and seed. There are still only a couple sources, and Upfront being the strongest for A-round money. And the truth is, there's nothing wrong with getting some Silicon Valley cachet in your deal. So what we argue is it's very hard to convince Silicon Valley C funds to do LA deals, but it is not hard to convince Silicon Valley A funds to do LA deals. And they can jump on a plane, come down here, kick the tires, look at the metrics, get conviction, and fly down for board meetings and do just fine. At the seed stage, it's every day there's a problem, and you need local resources and knowledge and access to the network that are going to help you hit the milestones to attract the follow-on capital. So that's what's been lacking in LA for 15 years since I've been doing this, but when we started Crosscut in 08, I don't think that's the case any longer. We have 10 micro venture seed-stage funds all actively pursuing opportunities, and something that doesn't resonate with us will resonate with Rich and Brian for whatever reason, right? Different points of view.
Yeah, Kevin, I'm curious to know your thoughts on the number of deals you're doing in LA and if there's more competition at the Series A round now for you.
Yeah, I mean, we probably do about half of our deals down in Southern California, and we'll probably continue to do that. There's just an increasing number of, as everyone said, good quality companies, and a variety of them, right? We see companies across not just, the stereotypes of, consumer and e-commerce or digital media, but you see plenty of enterprise companies and clean tech companies and hardware companies going after new tech and platforms like we already are. I think LA just has a lot of the right creative and increasingly the technical talent, both from LA University, but also people willing to come down from the Valley and from New York, move here and take on senior roles. I agree with Brian that actually there's not enough, and there has never been enough, call it Series A plus funds in LA. I mean, last year we saw 2 new funds, or last year Alpha Edison was new, and then March Capital has been around for maybe 2 years, and I think we need more. I think you always want a richer, more diverse source of local capital, because everyone likes different things. Every partner likes different things, and they go through different trends. maybe now I only care about healthcare companies, and I already have done 2 e-commerce companies, et cetera, et cetera. So I think we do need more variety of capital at the later stages.
Colleen, you give us a different perspective coming from San Francisco, and you have an LA presence here now. What are your thoughts on LA?
Yeah, so actually we first moved to LA when we came from New York and relocated to the West Coast. So the first fund was established in New York City in 2011, moved to LA in early 2013, and then we opened our SF office about a year and a half ago. So it's been interesting to see the change in LA even over the course of the last 3 years. When we first moved here, and I told people we're a fintech fund and we have an office in LA, kind of look at you like you have 5 heads, like what are you doing? First of all, there's actually an interesting financial services ecosystem here, significant established incumbents that are good pools of talent, and we're beginning to see kind of established credentialed founders who've built real fintech companies elsewhere in New York or Chicago or San Francisco proactively move to LA and start new companies here. And I can count 3 or 4 in the last year that fit that description. And that's really exciting from our perspective. So LA is becoming recognized as a place to build a company proactively, not just a place to discover kind of local companies. So I think that sends a great signal about the external perception of the talent here. I also think that, I'd echo the comments about Silicon Valley being more interested, more active down here. The folks that I see regularly up in San Francisco, I'm now starting to bump into in Los Angeles. It's an interesting dynamic. So I do think people are taking notice. There's real opportunity here. In terms of the funding landscape, I'd echo the comments that have already been stated that a lot of funds have raised significant pools of capital in the past 12 months. So I think there's plenty of powder to be deployed. It's really just a question of the bar being raised, as Brandon mentioned, and VCs, especially as we sit at the Series A stage, I think raising our credentials is what we want to see in terms of traction.
So we spoke before coming to this event, and one of our prepared questions was, after the 2016 slowdown, 2017 looks bullish for early stage investing in IPOs. And some of the VCs on the panel agreed and some disagreed. So who wants to tell us why they agree with that statement? Is there anybody?
Look, I can speak to the early stage, right? So a couple things have been happening on the funding front, right? People talk about kind of the barbell investing strategy where there are guys at the later stage, growth guys who are investing aggressively, seed, pre-seed guys like ourselves who are investing aggressively, but then, to Brian's point, at this Series A, some companies would stall out. I'm not saying that's a bad thing or a good thing, but there was just a lot of risk that growing companies couldn't hit certain milestones that they needed in order to get the next round of funding. What we're now starting to see, at least in 2016, and it could change in 2017, was that the public markets weren't there where the growth guys could get a return on their money and achieve liquidity as fast as they wanted. So once that portion of the investing spectrum goes away, it's going to have ripple effects. I'm waiting to see how that all plays out once 2017 opens up. I think the common consensus is that we're going to see a lot more companies go public in 2017, that nothing's going to change, and that's a positive thing, at least for us, since we sit so early on the stack, and we'll see the ripple effects as it goes down the investing spectrum.
I totally agree with that statement.
Brian?
So I mean, my lens on this is we raised 75 million, final close June of 15, and sat out the rest of the year because valuation were nuts. Deals were getting done by Silicon Valley funds down here at 2x the valuation that we thought was appropriate for the business. We just basically sat out. And I think in retrospect, that was a good call because the financing risk that those companies now face in trying to raise follow-on is pretty steep. So then we had the correction in early January with all the SaaS valuations, and I've told this story many times. 6 companies came into my office doing 100 to 150K of MRR, and the entrepreneurs were like, I'm going to the Valley, I'm going to get my 5 on 20, it's going to be awesome. And I said, when that doesn't happen, and you want to talk, 3 on 7 or 8 and raise a traditional seed, come on back. And all 5 came back. And it was just a sign of what was happening in the Valley. Now, here's where we're going to figure out whether Crosscut's any good at what we do. We did 12 transactions last year, more or less traditional seed deals. And so I was ecstatic to not have companies out in the market. I didn't have to raise capital for my portfolio in 16. And hallelujah, because that would have been painful. But now I got a bunch of companies going to market, so our aggressiveness as a fund in early 16 is now taking those seed companies. And by the way, we overcapitalized the crap out of those things. We raised $2.5–3 million when we used to do a $1.5 to $2 million seed round because we were nervous about having to go to market. So we overcapitalized them, and they still may not have hit the milestones that are going to attract the Silicon Valley A round. And so that's what's going to happen this year. I don't think we're any different than a lot of these funds. We all felt like the market had corrected and right-sized, and the right valuations for the right deals were happening. Good entrepreneurs, skilled in markets, blah, blah, blah. But now we have to go finance those companies in 2017, and we need groups like this to step up and fund the right businesses.
So would you say you're a wait and see, maybe first quarter, kind of dictate your funding pace?
Yeah, we had a portfolio review on Monday, and unfortunately, companies that I'm responsible for, 5 of them are up on the board to go to market in Q1. So I'm either going to lose all my hair and be completely stressed out, or it's going to go well, or who knows, and we'll find out.
Yeah, I think the greatest significance for folks in the room in terms of what's going on in the public markets is just this trickle-down effect on valuations. As investors, we do look at what comps are in the market. And so if your direct comps are taking an absolute beating, that's not going to help your valuation case. Obviously, we consider other things, and seed stage and Series A is a really long way off from a publicly traded company, but it still informs the relative magnitude, what we think that company's going to trade at in an acquisition, 5 or 6 years down the road. So that is significant. From the perspective of fintech, 2016 was not a great year in the public markets for fintech, if anyone's following that. There are a few really notable companies that took a beating, partially due to changing rate environment, partially due to internal compliance issues and various other things that were specific to companies. But I think for new startups, new entrants in those particular industries, and I'm talking about folks here like Lending Club and On Deck, that didn't help folks trying to start de novo, either balance sheet lenders, marketplace lenders, and folks in the credit ecosystem generally. And I do think there was also a significant, I don't want to say glut, but a large crop of folks starting companies in consumer and small business credit in 2015. And as investors, you sort of sit back and think about this in a cycle perspective and just ask yourself, where is consumer credit going in the next year or 2 years as people re-leverage? So I think, coming into 2017, it's kind of anyone's guess. Post-election, financial stocks have done really, really well. So that bodes well for folks in the financial services industry who've been waiting in the wings for a good IPO environment. So I think it's definitely conceivable. We'll see a few folks that have been lingering for the past 6 to 12 months actually come to the IPO markets, but remains to be determined in my book.
Kevin, anything to add?
I think last year, maybe one of the reasons to me that the market sort of didn't crater as people predicted in 2015 is, much like the mutual funds and the hedge funds came into VC market in 2014 and 2015, the overseas sovereign wealth funds and large corporate funds and money out of China came into the market in 16. And I think, I imagine they'll probably learn the same lessons that the hedge funds and the mutual funds did, which was that, overvaluing companies and promoting growth at all costs doesn't tend to work out and is not exactly the best story for an IPO. So I expect probably 2017 will be more like last year, if not a little bit down. But at the same time, I think this is a good thing. I think kind of like what Brian said about sort of the cleansing effect and what you said about the trickle-down effect. As the later stage companies have to focus a bit more on growing sustainable businesses, that hopefully moves down to the C stage companies, B stage companies, and A stage companies as well to be like, okay, I just raised that 3 from Crosscut. I better make sure I spend that in the best way possible and give myself some additional cushion should the market not turn out the way it is.
We have about 2 more questions, so get your questions prepared for us. Next question is, what are you currently funding? So within the last 6 months to the first half of this year, what are you thinking?
We're looking at generally consumer businesses, but we like to look at businesses that have B2B2C plays. And what I mean by that, a consumer product that goes to market has some other form of lead generation other than Facebook, right? And I think there's something to be said about a lot of these consumer businesses coming to us and saying, how are you going to grow to 100,000 users, 500,000 users, and so on? And they're like, well, Google AdWords, SEO, the traditional norms. I personally, and what we've looked at in our portfolio in 2016, is looking at those companies that have a less, I don't want to call it traditional, but standard way of growing, and can do sort of a BD approach to B2C. So when we look at a company that's, I'll use my previous company, Zeal, which is a B2C massage on demand company. When Zeal is looking at growing the market beyond just straight, again, Facebook or SEO or Yelp or whatever it is, going a different route and saying, hey, we're going to actually go and power spots. We're going to go land business development deals where we can use our consumer market and make extra revenue and grow the market that way, and use channel partners to get more customers in a variety of different ways. So I find that to be really important. I think we'll continue that moving forward in a variety of industries.
We know consumer extremely well. A good proxy for how we invest is to look at an opportunity and say, if we had the time, is that a company we would build, right? Because if we can say yes to that, then it's pretty obvious that we can tilt the playing field in our favor. And a lot of it is, for the type of companies that we love, consumer, it's less about raising a big chunk of money and doing the standard acquisition, marketing, and it's really, how can you be lean, how can you hit the milestones, understand what your objectives are going forward, and then back into those objectives with a sane plan that doesn't require a shitload of money, right? Because if you miss your milestones and you're building a consumer company, you're dead in the water. So we want to be careful about investing with the right investors, the right entrepreneurs who have the discipline, and as well as a plan to really work with us to build it in a way that we know we can help them on the Series A raise. Because our reputations are on the line. If we're calling up Brian or Kevin or Graycroft, it's essentially we want to show them something nice, and we want to make sure that it's attractive to them and it's not a waste of their time, because that's our lifeblood, right? If we can't get money for our seed or pre-seed companies, then we offer no value for any of the companies that we invest in.
So it sounds like very strategic startups, more depth in how they're getting to market. Brian, so you said that you're funding whatever comes out of LA. Maybe I misspoke, but can you go a little bit deeper into what that looks like in 2017?
Sure. The point I was trying to make is not that our wallets are wide open and just come take what you want. It's more that the areas of opportunity that we're seeing innovation within are way more diverse than they were when we started the fund in 2007, 2008, right? Like, LA was built on the dirty underbelly of web monetization, and the first generation of successes, those companies that were the foundation of LA, were not sexy businesses, but they made a lot of cash and they sold for good multiples. And then e-com with ShoeDazzle and JustFab and all these businesses were, Nasty Gal and all these things. Some came and went, but most were still foundational in the evolution of what we call retail tech as a category. So we try to do things that we actually have some expertise in, right? So one of my partners is all over VR and gaming. He ran all US operations for Square Enix. My other partner, Brett, was the co-founder of Intermix Media, which owned MySpace, and they scaled an ad tech business of $350 million. I started my own e-commerce company called Style Saints. So we try to find things that we actually know something about, and we can sit down with an entrepreneur and be like, oh, I've seen this pattern before, let us help. But that bucket now is pretty wide, right? So it's SaaS, it's retail tech, it's gaming and esports and next-gen media. These are the areas that we like. Marketplaces, we've done a fair amount of marketplace investing, over 60. And I just keep seeing new buckets pop up every day, which is great.
Colleen, what are you funding currently?
Yeah, so I'll share sort of the 4 broad themes that we're interested in, and within each of these themes is like numerous potential sub-verticals. But so in general, we do a lot in credit, like all shapes and sizes and flavors, consumer, commercial, secured, unsecured, the data ecosystems around that, in some cases the enabling kind of software infrastructure around origination, processing, servicing, so that whole ecosystem around consumer credit. We're interested in financial health, so we describe that as both risk mitigation, downside protection, so think the insurance industry, as well as asset accumulation and upward mobility, so think next generation savings, retail investments, retirement tools, all of that. We look a lot at infrastructure, so kind of driving efficiencies further down the tech stack, something like a next-gen payment protocol, that a replacement for Swift, if anyone here is nerdy enough to know what Swift is, a next-gen kind of credit decisioning engine, pulls in alternative sources of data, et cetera. We invested in a company called L2C years ago that we sold to TransUnion a few years back. That was kind of one of the first to really do alternative credit decisioning. Recently invested in a company called Mirador, which is that bank tech bucket, allowing banks to basically compete with online lenders in terms of speed and efficiency and experience, but drops their cost basis so they can do so profitably, and they can do so far, far more cheaply because they have depository capital. So that's some stuff we've done on the infrastructure side. And then finally, we're really interested in a macro trend that doesn't fit neatly into any specific sort of financial services category, but we describe it as the future of work. So the shifting norm in America away from kind of a full-time, stable, predictable W-2 employment status to a much more contingent, independent, hourly contractor. There's like 1,000 different flavors of that, but the fundamental principle is that it's no longer a one-to-one relationship between an employer for 20 years and an employee. And that actually has massive kind of fallout on individuals' financial lives. Everything from benefits and insurance to wage optimization to planning and stability. So we're really interested in tech tools that are kind of reimagining the social safety net in light of that shift, and helping individuals navigate and manage earnings in that new environment. So those are a few big categories. I personally have been nerding out a lot on mortgage recently and the whole ecosystem around not just the origination, but title, appraisal, servicing, again, the whole ecosystem around that transaction.
Kevin, any?
Yeah, I think a question we've kind of been asking ourselves internally over the last 6 to 12 months is this a VC type business or is this a PE type business? And what I mean by that is, as technology becomes much more pervasive in all kinds of businesses, you will only get more and more companies and startups that are leveraging tech to speed up efficiency a little bit, improve workflow a little bit, but ultimately they're still fundamentally a people-driven business or a services business or a consumer products business or whatever it is. And I think at the end of the day, we want to try to focus as much as we can on a very strong tech differentiator for any of these kind of business, as opposed to I have improved my margins by 20% versus my competitors in some old industry. So along those lines, I think in particular I focus a lot on VR and AR as well as healthcare, and I think in both these areas there's been tremendous changes over the last couple of years as large companies put tons of money towards infrastructure building and giving you the platforms and the hardware that whether you're a content creator or you're a technology creator or an application creator for enterprise use cases, you can actually starting to finally access a larger user base. And I think LA is particularly good in these areas when it comes to sort of really thinking about what is not just a game, a 3D game that I used to play on a PC or a mobile or a console that now I'm going to just shift into VR versus, well, let me reimagine what a social music experience would actually be like when you feel like you're physically there. So
I'm going to stop you there so we can take some questions from the audience. Anybody have a question? Please raise your hand.
So during events.com, they talked a lot about pivoting. Can you guys discuss if you were involved in the discussion about pivots? And do you typically bring those up as well when you see a company maybe needing to pivot, or do you wait for them to bring it up to you?
Having an accelerator program, you're getting companies that are incredibly early, even the companies that we fund in our traditional venture side. So one of the companies that's in our program actually pivoted right before joining the program. So we committed to a deal on a completely different premise, and they came, well, not completely, but a fairly different premise, and they came in and pivoted. Totally fine. Do I look good backlit? But when they pivoted, we had to have a totally different mindset, because coming into the program, we had a completely, thought out process to how we were going to help them tackle the market that they were going after when we did the vetting and the diligence and so on. And so they came in, and we had to kind of think on our toes and move really, really fast to help them with this process. We're currently going through that, and it's really important to this point that you have to move quickly. There's only a certain amount of capital, and so what Brian said, even $3 million goes really fast. And so if you spend a month sort of trying to make something that you know doesn't work, you could be out of business. And so I actually appreciated the fact that they recognized fairly quickly that the model that they were going after that we thought would work wasn't working for a variety of reasons, and having to make that move towards something that they still understand and it's still somewhat in the space. But we are moving quickly to avoid spending $300,000-$400,000 on wasting a bunch of time and money on something that clearly wasn't working. So I think that recognition is something that both VC and entrepreneur have to be in a line thought process. But making that switch almost gave me more confidence in the entrepreneur, knowing that they were willing to do something that is not easy to come to that conclusion fairly quickly.
Thank you. Any other questions? All right. Marissa, how are you doing?
Hi, how are you? You guys are doing a great job. Thank you. Perfect, thanks. So, being somebody who loves many industries that you named, but essentially I love frontier tech and hardware, what advice would you give to seed stage companies within these industries in particular, given some of the industries that you mentioned that you didn't really mention, frontier tech or hardware? So what does that look like for the landscape for Series A funding or beyond the seed stage?
Who's doing frontier tech? Kevin?
I'll just talk about hardware because frontier tech is super broad. You could be talking about space satellites versus next-gen AR headsets. I think VC's got excited about hardware and IoT call it over the last 3 or 4 years because all of a sudden you're starting to see the cost curve really bend down when it comes to a lot of the components you need to build any sort of at least consumer-facing hardware products. And I think one of the most important things for you to start a hardware company now is the resources are all out there. Like a lot of the manufacturers are out there with their own programs, trying to give you free credits and advice on, as you think about designing a product, how to make it, cheaper and more suitable through their design process, etc. So make sure you go out there and just leverage those free resources before you show up to a VC and it's like, I have this idea to make this widget and here's a rough looking prototype. I think I can make it for $20, when in reality you look at a competitor and it's like, that guy made it for $1. So I think, most consumer-facing hardware IoT products you would want to make, there's probably a comparable out there. Like study them, figure out what they've done, and try to be, not just 50% better than that, but 2x better than that, 3x better than that.
And I would say, find your hardware community. There's Hardware Massive. There's a ton of communities out there for hardware founders, hardware startups, and you can learn a lot from others. And just through the whole hardware journey, there's so many ways to go wrong with components and suppliers, and so definitely find your community. I know one, and that's making a leg. Right? Any other questions? I see one back there.
Yeah, I'd be curious to know, it's a little bit of a broad question, but particularly maybe from the talent side, what are the biggest challenges? I mean, certainly I imagine on the IT and the dev and product side, but I'm curious, what are the biggest challenges your companies are facing from a talent side down here?
What I'm seeing is it's not so much talent, like we're doing a much better job of retaining the engineers that are coming out of our universities. It's still competitive, but not like Silicon Valley. What I'm finding is finding great product people has been the hardest hire for any of our companies. There's just not a wealth of that in the LA ecosystem at this time.
Why is that? Why do you think that is?
I wish I had a better idea. I mean, we are a sales-oriented culture and a storytelling culture, but I don't know if we go deep into deep product design methodologies the way the Valley has bred those types of individuals. They're starting to come down. That's great, but that's always what I find is the hardest recruiting that we try to do.
Any other questions? Did you want to add, Colleen?
It's not burning.
All right.
Let me just offer one thing up, because I know many of you are entrepreneurs that want to sort of get to us. I'm going to offer this out for anyone in the audience. Crosscut hosts an open office hours, and it will be on March 2nd. And then all you have to do is reach out to Sarah, S-A-R-A-H, at crosscut.vc. So sending you a link, you can schedule, you can come by the office, you can get in front of any of the 4 or 6 partners we got. And that's a nice, easy way to facilitate smooth conversations. The idea that there's going to be a lot of follow-up for all of us in our inbox, especially when I'm preparing for our LP meeting, is overwhelming and scary to me, and I don't want to let everyone down. So I'm pushing everyone in that direction. So we're saying, hey, happy to give everyone feedback. We want to be helpful to anyone in the ecosystem, but March 2nd is a great date to come on out and tell us what you guys are up to.
Anybody else with a closing comment? Quick, before we get
Yeah.
run on.
Yeah. I don't. Are you guys going to be sending out our emails or anything? Or are we? Yeah.
I don't.
So yeah, we're going to be looking for accelerator companies over the next couple months to join on pre-seed. So feel free to email me. Same thing. I'll get back to you eventually. But you can email me. It's very simple. My first name at lumalaunch.com. Happy to take that, and then we can schedule a time separately.
Anybody else? And for those hardware founders out there, if you know of any hardware folks, Macon LA is holding an event on February 3rd in Santa Monica called Toolbox LA. So thank you very much, everybody.
Thanks, everybody. Awesome time. Very informative.